So please welcome, take some notes as you go. As I said, you'll get a copy of the slides at the end of the presentation, and then hopefully we can go forward from there. Okay, a bit of an introduction to this series. This is the second session in our series. The first one exactly a month ago on February 8 was around the why with succession planning. Why are we doing succession planning? What's important about it? And also market research, but also we talked a little bit about the psychology of succession. You know, what is important when we're dealing with business owners around succession planning and what they're actually looking for as they prepare for succession, etc. Another 7 sessions to come, 8 actually, I can't even count, another 8 sessions to come, talking all about succession planning, but various specific topics that are needed as we work with clients on our succession planning process. So let's get right into it now. A bit of background. I won't spend much time on my introduction. I think a lot of you have already known me, and those ones that were on the session last month probably don't need to hear that again. My practice is entirely focused on succession and exit planning, so we do a lot of work in this space. We work very closely in collaboration with accountants, lawyers, financial planners, and other advisors, business coaches, etc. And whilst we are accountants ourselves, 3 of my 4 partners accountants in public practice previously, we don't do any accounting and taxation work anymore. We work more closely with the client's accountants in that particular space. As I said, a partnership of 4 people. Michael Vincent, who's based here in Sydney with a background in M&A, particularly investment banking, etc. Scott Patterson, Don Poole have similar backgrounds to mine, which is accountants in public practice. We also have a large number of accredited advisors. There's 24 currently around the country. We've got people in most capital cities and also several country towns. And we are looking for more people in certain areas where we've got a little bit of a shortfall in the number of accredited advisors for that particular region. There's more information on that on the website if that's of interest to you. Now, I do want to talk in a little bit of detail about our process before we get into the valuation side. And I guess you'll see stage 2 there. The first thing that we're going to look at is stage 1, identify value around the stage 1 report, which we call insights. We're going to have a look at that today because included in that insight report is quite a detailed valuation of the business. And that's really important from a business owner's point of view as they prepare and start to think about succession and exit planning, because there are obviously lots of questions that are at least partly answered by looking at a valuation. You know, what's my business worth? What are my exit options? How much would I get if I sold it, etc. And then that is obviously the first step in the process to start to work out what are the exit options available to you, how might you be able to exit, etc. And if we do that, then we'll have a pretty good framework to start the conversation about succession and exit planning as we work through that process. So let's have a look at, before we do that, let's have a look at just about to be published now is the new version of Enjoy It. This last was published in 2013, and we've just updated it with substantially more information, updated research, but also a client case study, which is a non-existent client, but it's a detailed case study of the client and how we work through with that client through the succession plan. So if you want a copy of that book, flick me an email after this, send me a note, and we'll get one out to you. And I'm just going to answer a couple of short messages. I'm getting some questions here from people on the audio. So if anyone's got a problem with that, please let me know. The second book that we're looking at here is particularly on employee share ownership plans. So that will be coming out in the middle of the year. And again, if you want a copy of that, please let me know and we'll get that moving for you. Now let's have a look at the topic for today, which is business valuation. As I said, a key metric, key thing, that part of our process that we always start very early in the process. And in fact, our policy is that for clients that come to see us, it doesn't really matter what they're particularly after in terms of advice. If they're looking to sell or an employee share plan or any other particular outcome, then the first thing we do is a business valuation. We call it an insights report or a stage 1 report, but it includes a valuation. So we're going to have a look at that and how we prepare it and what are the key factors that go around it, just to give you a bit of clarity around how that might work. So what are we going to cover? The first thing is the valuation theory and the methodology that we actually use. We're going to talk in a little bit of detail about our risk assessment, because that is obviously a key factor in determining the valuation. We're also going to talk about cost of capital and why is that of any relevance to anybody anyway. Have a look at some reasonableness tests, because it's quite okay to go theoretically and value a business based on a complicated formula or a spreadsheet or a model like we use, the software that we use, etc. But you always have to come back to the reasonableness test. Make sure it is actually reasonable in the market given the current environment. And we're going to have a look at some case studies. So I just want to talk briefly. We get asked a lot. Sometimes we get business owners come into our office and, they'll say something like, I think my business is worth 10 million or even 50 million. Interestingly, when you start to ask them how they got that number, it's because they quote things like this. Microsoft acquired LinkedIn, $26 billion. Apple, purchased a startup which had very little turnover, etc., for $200 million. And they're strategic valuations, and they're very glamorous. They're exciting. People read about them in the media. You see Facebook purchased Instagram for $1 billion, even though it had no revenue. So business owners come back and say, well, I've got no revenue. Can I get $1 billion? And of course, the answer is no, unless you've got some substantial strategic value. So one of the lessons out of this particular aspect is that it is very, very difficult to get clients to understand the real valuation of their business. And that works both ways. We do have clients that come in and say, well, I think my business is worth nothing, and it's actually quite a substantial, valuable business. And we get the other extreme, as I said, people that come in and think their business is worth multi-million dollars, and it's actually not really the case. So it is important, but I think it's also an important reality check based on some of the comments we made last month around the psychology of succession. It's really important people get this part clear in their head. What is the value of my business, and therefore what are the potential options available to me going forward? And I love this quote from Warren Buffett: price is what you pay, value is what you get. And in any business, you have to always remember, yes, there's a formula, yes, there's a process and a methodology, there's training you can do, there's all sorts of things you can do to sort of fine tune that valuation outcome. But price and value are often different. And I always say to my clients, yes, we valued it on paper for $4 million, but you have to look at the market, the economy, the potential buyers out there, etc., to make sure that's actually a realistic number. So let's have a look at that. The simple valuation formula is this: earnings before interest, tax, depreciation, amortization. And there is a comment there around normalized earnings. We're going to look at some add backs and adjustments in a moment and what's typical there. And then the big question, which is the earnings multiple. And there's a number of business owners now that are reading about this in the media, hearing stories, watching things on the internet around businesses being bought and sold in the United States or Silicon Valley or Israel, startups being sold for a particular multiple. And that's very confusing for most business owners. They don't really understand what the multiple is or what it's actually telling them. So the simple formula is earnings times the multiple gives you the valuation. It's never, ever that simple, obviously, in real life. What we also know is this is an interesting trend to look at, updated right up till December 2017, as you can see. Both the mean and medium index trends over a long period of time, this graph covers nearly 7 years, has been trending downwards. And it's been trending downwards quite consistently over that period of time until it's somewhere in the low sort of 1.5, let's say, is probably the average of those two lines there. So that is an issue that business owners aren't aware of, because they're reading the glamorous stories in the press about businesses being sold for 5, 6, 8, 10 times earnings. And the reality is a lot of businesses, particularly at the smaller end of the spectrum, sell at much, much less than that in terms of multiples. So it is important to understand that. And we use graphs like this when we're talking to clients to outline to them exactly what the market is actually saying about their value of the business. That's not to say they have to sell for that multiple, but that's really what the market's indicating. So let's have a look at what we call a stage 1 insights reports, which is our detailed valuation. So first step of that is really to get clear on the structure, who owns what. And unfortunately, a lot of businesses are still getting this wrong. This is not a real client. Obviously, Smith Engineering does not exist. It's a made-up client that we use for our training and case studies, just to give you a bit of an example and a reference point. But you'll see here, fairly typical. You know, you've got mum and dad, in this case, John and Jane Smith, and also Rodney Jones, owning shares in Smith Engineering. They typically own them in their own name. This one's got 100 issued shares, I think. But it's not uncommon to see literally a $2 shelf company where Jane Smith's got one $1 share, John Smith's got one $1 share in Smith Engineering. They're both shareholders. They're held in their own name, as in beneficially, which this diagram shows. They're both directors, so they're both at risk. If something goes wrong or if there's a problem with this business, they'll both be at risk. And also, you know, I guess not everybody has this, but certainly some people do, where this business has actually purchased a factory, and they've done that inside the trading entity. Unfortunately, not everybody uses the correct structures as they go through. So one of the things we look at, and this does have an impact on valuation, but it also has a very big impact on things like capital gains tax. So not only do we have to think about the valuation, we have to think about, well, if we realize that value, what happens then in terms of valuation, in terms of the taxation impact of that asset being held in a company. So for example, if we sold that company, then we're going to pay capital gains tax at the company taxation rate. If John and Jane held that in some other vehicle, they may well be able to get, in fact, they definitely would be able to get a much better rate than that. So one of the things we look at is ownership and structures. So this is an example of the sort of advice we might give around the business structure: owning those shares in a family trust, putting a holding company in place, separating some of the assets in the trading entity, but also separating the building out into a self-managed super fund, for an example. Now, obviously, you need much more detailed advice than that around that structure, but that's important from a valuation point of view as well. For a number of reasons. One, we can separate some of the add backs that we're going to talk about in a moment and make sure we can legitimately show those as real costs within the business, but also from a taxation point of view, and sometimes even a simple operational efficiency point of view. So that's important to remember and have a look at as part of the process. The next thing we do is obviously get into the financials. It's not possible to do a valuation without looking at the financials. I've seen many where, and there's even some online stuff where you fill out three answers or 4 fields in a form and it spits back a valuation at you. Well, that's just not possible. You need to do the financial analysis. And obviously what we do is recast the profit and loss statement. You'll see on there that down the bottom here, in the section down the bottom, you've got some area for abnormals and adjustments just down the bottom here. That's where that sits, so you can see that. That's an important area. You'll also see, obviously, it's simplified version. We're not going to go through an entire P&L, although we have done that to produce this particular statement. The next thing we do is look at the statement of position, balance sheet. We separate that into finance and operating balance sheets. And so that's fairly important just to look at the overall position. And one of the key things that this process, I guess, engenders is a discussion about a whole stack of things related to the business that do have an impact on the valuation. So, for example, are there other assets that are inside this balance sheet? I worked with a client very recently, did this exact process with them, and found on their balance sheet there was something like $750,000 of listed shares. It's just an investment, nothing to do with the trading entity or the business itself, but they were basically sitting on the balance sheet. And that does muck up the calculations in terms of asset usage and turnover and so on. It becomes quite messy. So we do have to think about, what else is the balance sheet telling us in terms of capital, its employed investments, etc., and also to look at the debt facilities and the effectiveness of that debt being held in the company. Now, the next question that comes up, in the area where we get a lot of confusion and questions, is add backs and adjustments. So the first things to look at are anything that is not a normal operating cost of that business. And the most common ones are probably identified on this slide. By far the most common is market salary for the owner or the director. And what you'll see is one of two things. Either the director is paid nowhere near market salary, as in they're paid literally $79,900, because that puts them right under the tax bracket, or they're paid $500,000 simply because they can, but neither of those is a market salary. And so you'll see in the middle of that screen there's an adjustment to bring that salary to a market position. If we were going to replace John Smith with a CEO to run this business, typically what would that CEO earn? And we've adjusted the salary according to that. Market rent, as you saw in the slides before this when we were talking about the ownership of the assets, you'll often see that the company or the family or their super fund or somebody related to them owns the building. And sometimes that means they don't pay market rent. They may pay over or under actual market rent. So we always need to get a market rent figure to make sure it is actually being charged out at market at the real rental rate. The other stuff that we see regularly is superannuation for directors, sometimes donations. I've got one client where the director is the president of a fairly substantial football club, and that company makes fairly substantial donations, sponsorship style. Sometimes we see private expenses, particularly things like travel and motor vehicle usage, etc., inside the company. And of course, small privately held family-owned companies typically do that quite regularly, and it's quite okay. But in terms of valuation, it's not okay because it distorts the operating performance of the company. The profitability is obviously lower if you've got a whole stack of personal expenses going through the balance sheet, the same as entertainment, etc. And look, there's a number of things that come up in this particular area regularly, but it's about going through and identifying those, making a table like the table that you can see on the screen to sort of highlight what they are and use them to adjust back to what we get what we call a normalized earnings figure, to try and find out exactly what would this business make in terms of profitability if it was run by an independent CEO, paid a market salary, if it paid market rent, and it just had business-related expenses, then this is what we're trying to adjust for here. The other adjustment that's fairly common is more not so much an adjustment or an add back, but it's an abnormal, and it might be something that's happened during this particular year that's never happened before and very unlikely to ever happen again. And then we would adjust that out. So it's a matter of just identifying. The biggest trick with this is to identify these things so you can adjust for them and get the owner to describe them to you and what they are and why. Then we start to look at some of the actual valuation parameters, and some of this stuff is directly related to the valuation formula itself. Some of it is not so related. Now, one of the things we always look at is the financial trends, the trend analysis. And in some business, this one on the screen is actually quite stable, quite steady in terms of both revenue and profitability, but you'll occasionally see businesses where there is massive variation year to year. And that is certainly an issue around valuation. People are going to be quite concerned if your company makes $1 million one year, 200,000 the next year, 1.5 the next year, 400 the next year, because there's no sustainability or stability around those earnings. You're certainly going to get some queries around why that's the case. And as soon as you get that, you're going to have, if you're thinking about either a buyer or an investor coming in at some point as part of your succession plan, you're certainly going to get some issues around explanation. Somebody's going to say to you, well, in 2016, you had a terrible year. What's that about? What caused it? Why? Can you explain why that's happened? And more importantly, can you explain why it's not going to happen again? Because if it happens again in 2018, I've got a problem. So that creates some variability. So important to understand how that works and just have a look at that. We also create a financial scorecard, and it gives us a rating for the performance of the business. You can see on this slide some of the key things. Obviously, red crosses are bad. So in this case, down the bottom right-hand side here, we've got some asset usage metrics that are not quite fantastic. But mostly we've got some green ticks, and this is not unusual. A lot of small privately held companies perform reasonably well financially, and we'll have a look at what that tells you. Obviously, we track those ratios and we talk through with our clients on what those various ratios are and how they work so that we can get a clear picture of exactly what the financial performance of the business is actually doing. Not directly related to the valuation, but an important part of the explanation and discussion with clients in terms of the valuation. Next thing we do is a break-even analysis for two reasons. One, we want to understand the difference between fixed and variable costs and get a really clear view on the balance between the two and what would happen if we've got a large safety margin at the bottom of this screen. Then we're okay if we lose a major client or we drop off 10% of our revenue for some particular reason. But if we dropped off 50%, are we going to be in serious trouble? And that's the sort of stuff that we really need to sort of have a look at and consider as we do the valuation as well. Next thing we look at, and this is quite important because, as I said to you before, the important factor, or one of the two important factors in the valuation formula, is risk. And we have to get a very clear view and understanding on the risk profile of this particular business. So we do a non-financial analysis, which actually looks at a number of particular different areas. On the top left-hand side, governance. So we're starting to look at the questions around management of the business. Does the business have is it dependent on a key person? The answer is nearly always yes, it is. And that's obviously a risk factor. Does it have a board in place? Does it have independent directors? Does it have a board reporting pack and a management pack? What's the management team look like underneath the primary or the principal owner, etc.? On the top right-hand side, strategy. Often in small businesses, as is the example with this one, not a hell of a lot of time and attention is being put on strategy in this particular case, so that's a bit of an issue. We look then at risk management on the left-hand side, the financial management down the bottom, etc., and obviously people on the right-hand side. And all of those key things, whilst any particular one of them is probably not vital enough to make a huge difference in terms of the risk scoring, added together, this particular business, by example, is an E+, which is a pretty bad score, and it's unfortunately not that uncommon to get a score similar to this sort of rating. And so you'll see here that you've got some fairly significant issues around the management of the business, non-financial issues, obviously, but obviously they will also contribute or detract from, in this case, performance of the business over time. So we need to just be aware of those and manage those as we go. We obviously look at those ratios. There's some scorecards there. We're not going to go through that in a lot of detail, but it gives you an idea of where we're particularly easy or light in terms of the valuation metrics risk. Next step we look at is exit readiness and attractiveness. And this does have an effect as well, as does the previous slide. This does have an effect on the multiple, the valuation multiple as well. Some businesses are very well prepared for exit. They're very attractive to the buyer, and therefore they can generate a higher multiple. So some examples of that would simply be, and I won't go through all of these because there's quite a lot of things on this particular slide, but some examples of that would be the simple comment that size does matter, for example. How attractive is the business to a buyer? Well, if the business is over about $7.5 million in turnover, it's more attractive because it's larger. If it's got multiple locations, for example, has it got export revenue as well? Is there a defined growth strategy? Does the business own some strategic IP? Is there some product or branding or trademark that the business owns that's actually quite valuable? If that's the case, then there is a strategic value. The other thing we look at is, how ready is the business for sale? So top left-hand side, you can see 5 red crosses. This business is not ready for sale at all. It's got no management succession strategy. It's very dependent on the owner. There's no incentive plan in place. On the top right-hand side, the financial and corporate governance is actually quite okay in this particular case, but there's a few issues around some of the issues with that particular area. Business model, sales and marketing engine, we're seeing a lot of attention coming on that bottom area now. So from a valuation perspective, for example, we're getting buyers regularly asking us now for things like Google AdWords history or website data for the last 5 years. I was asked for not long ago. That's new. It hasn't been the case, 5 years ago, very few people were asking about that. Now we're starting to see people asking about Facebook, LinkedIn, Twitter followers, the number of people that are on media, how much engagement do you get with social media, etc. That's new. And so that is an area where business owners need to be aware. Their sales and marketing funnel is obviously important, and how it's managed is also important, because from a buyer's point of view, that provides some stability to future earnings. And that's an important question. We won't go through the scorecard there. That's now what we will go through is the risk assessment. And obviously we've just looked at a number of the key areas where this is going to come up or where this is a particular issue, so we can get really clear on exactly what this particularly looks like. So you'll see on this page, there's 18 different metrics that we use to measure risk, and we obviously treat them at the bottom of the page. We add them up in total, and that's one of the calculations that we used as part of our particular model. So the first thing to look at the top of the page is future impacts. I'm going to go through these one by one because this is a very important part of the analysis to get really clear. If you have the sliders or the bars that move across, the sliders in the middle of this particular page is 0. That means that this particular business is neither higher nor lower risk than the rest of the market, or the average business, if you like, in this particular market. So the first one is future impacts. And most small to medium businesses do have some risk around future impacts, but obviously some have more than others. So in some cases, if you were, for example, a video store 5 years ago, your future impact risk would be quite high. This is about disruption normally. And so in some businesses, they're very, very open and very, very susceptible to disruption, and so they're going to be higher risk. Interest rates, typically in Australia at the moment, interest rates are not a massive risk. Neither is inflation, down at number 9. And for most of our clients, neither is 15, foreign exchange impact. So you'll see they're fairly lightly weighted. But for some of the other areas, if you look at type of business at number 3, and location, location is not necessarily a metric of where the office is located. It's more about location diversity. So if you had, for example, an accounting firm that had an office in every capital city and 5 regional towns in Australia versus an accounting firm that only had an office in, let's pick somewhere, Wagga, then you are going to have a different type of risk. If the economy in Wagga Wagga has some sort of shock or experiences a downturn because of a drought, for example, being mostly regional, then that accounting firm would suffer as a result of that. The accounting firm that had offices in 5 different states and country towns, etc., would hardly notice. And so that's about location diversity. Management skills and performance record at number 5 is a big one for most small to medium businesses, because we've got some key issues, and some of the things that we started to look at in those non-financial risk criteria then become important. So one of the things we looked at was key person dependence. If you've got a business that's entirely dependent on you, or that's entirely dependent on you and your brother or your wife or whatever it is that runs the business, then you're going to have some issues around management skills and performance record. This also speaks to things like management succession. Do you have people, younger people underneath you that are coming through the system that are being trained and upskilled, who can take over from you? Product mix and competition, a little bit similar, obvious. That's pretty obvious what those ones are. I'm not going to go through that in any great degree, but there are some businesses where they're quite susceptible to competition, etc. Some businesses where product is becoming a bit of an issue. You know, if you've got people that there are businesses around that used to repair TV sets and video recorders, well, those businesses aren't that successful anymore because our culture now is that we throw it out and buy a new one rather than spend any money fixing it. That never used to be the case because of the cost. Now that's a very different sort of model. So you'll see people are actually looking to change that product mix and to get into different levels of competition. Past performance sustainability. I talked before about the trend analysis. If we've got massive variations in income up and down and in and out, and one year's fantastically good, the next year's terrible, the next year's just okay, the next year's even better, then we're going to have some issues. We're going to struggle around some of those key metrics around sustainability, and we need to convince this is all being looked at, don't forget, through the eyes of a buyer or investor. Inflation's not really normally a problem, particularly at the moment in Australia. Intellectual property, this is somewhere where you may well have lower risk as a result of this. If you've got intellectual property that's well documented, valuable, it's producing income, it's all registered, so you might have some trademarks and branding registrations, some IP protection, etc. That may well be lower risk. Barrier to entry, this is becoming more and more of an issue for most small to medium businesses, depending on the particular business that they're in. It used to be quite difficult to start up a business, any sort of business in Australia, and it would be expensive. You'd need time, you'd need capital, you'd need a stack of resources in terms of things like IT infrastructure, etc. Well, now that's quite easy. I noticed the other day an advertisement for ANZ Bank where they promised to have your business set up within 24 hours. So that is not just a bank account, that's register you for an ABN and a tax file number, open a bank account, set up credit card payment facilities online, design you a website, et cetera, you know, phone number, the whole thing. So you could literally open a business, register, set up the things that you need to go out trading, and you could go and service a customer tomorrow. In some businesses, we do a bit of work with the fire protection industry, for example, with people that maintain and repair sprinkler systems, etc. Those guys are particularly susceptible to this barrier to entry risk because it's quite easy, and we've had a number of cases where a good employee simply leaves, they go out and buy a Toyota Ute, they put some equipment on the back of it, and the very next day they can compete with you with a much lower cost base. So that's an issue for some businesses. Market share is obviously a key issue for some businesses, and that's changing, as I said, with disruption and with the new technologies that are coming around with things like freelancer and so on. You know, if you're a garden landscaper, you had a very good market share in your area, you're now competing with uni students who go on freelancer, and so they'll do your garden landscaping for $25 an hour. And it's a difficult thing to manage. That's that barrier to entry market share sort of equation. Specialised asset and technology are applicable to some businesses, but not all. In some businesses, the issue of having a specialised asset may well be lower or higher risk. It also is a technology question around, how susceptible are you to changes in technology and or technical disruption as well. The two big ones that we look at are 16 and 17, marketability of equity and marketability of ownership, and they are a big issue. For most small to medium businesses, particularly in our case study example where a couple of slides ago we had our non-financial analysis coming in at E+, that means there's a lot of risk in that particular business and there's a lot of issues, and therefore the marketability of equity and ownership is actually quite high. The software that we use actually puts two sliders in for this particular area, even though it's almost exactly the same thing. So it is a big risk factor. For small, privately held, typically family-owned businesses, this is probably their largest risk. How easy is it to sell the business? That's what that's trying to measure. And the last one is user-defined risk. We normally use that as a reflection of the score that was on the non-financial scorecard. So at the bottom of that page, you can see that all of that adds up to 2.6, and that number then creates an asset beta on the right-hand side there that's carried forward to our next page of calculations. Next thing we have to work out is obviously cost of funding. So you can see weighted average cost of capital we're trying to measure here. The first thing we do is work out our cost of our debt. So our marginal interest rate there is 7.41%. We're assuming we've got a corporate tax rate of 30%. Therefore, our net cost of borrowing funds is 5.19% on the top right-hand side in green. In the middle of the page, we're determining our cost of equity, which is always, or nearly always, higher. Our risk-free rate of return, 10-year government bond rate, is 2.5%. Our market risk premium, because we're not in that market, is 5%. Our asset beta is simply carried forward from the previous page. And then we've got a market value of debt over capital for this particular business. So we've got a percentage debt versus capital, and therefore we get a leverage beta. And our cost of equity funds in this example is 34.3. So you can see quite expensive in terms of that particular cost. The next thing we do then is give a weighted average of those two numbers, and we can end up with our weighted average cost of capital on the bottom right-hand side. That's a very important number that most business owners don't understand, and I actually spend a bit of time explaining this to them. It's important because this is a risk-weighted cost of capital. It takes into account the risk. You can see the asset beta in the middle of the page there that we've used to calculate that, and that's quite an important thing for them to understand, because what I explain to them is that this is the return you need to generate given the risk of you being in that particular business. If you're going to go and put your money in a fixed term deposit with the Commonwealth Bank, the risk profile is completely different. And therefore, they'll only give you a return of 3 or 4% at the moment, but the risk profile is different. The chances of you losing your money, almost zero, because it's now government guaranteed. The chance of them not paying you the 3 or 4% return is about the same. It's almost zero. And so the return is much lower because the risk is much lower. In these businesses, and this particular business we're looking at here, Smith Engineering, the risk is higher and therefore the return needs to be higher as a trade-off. And that's what that number is important in terms of calculating. That's an interesting conversation to have with business owners. On the next screen now, we're actually comparing our return with the weighted average cost of capital return. So on the top left in green, you can see the profit and loss, ending up with net operating profit after tax. On the bottom in the left in blue, you can see the balance sheet, you can see the total assets employed, and the software will calculate what's called ECROC, so the economic return on capital employed, which the important factor here is that's got to be better than the weighted average cost of capital on the bottom right in the red square. So as long as we are achieving a return better than our cost of capital, then we're creating economic value, and we've got a positive valuation in terms of business because our return is better than the return that would be required given the risk factor that's in that particular space. So we track that over time. We typically look at 4 to 5 years history, and we track that performance versus the weighted average cost of capital over a period of time. We then walk forward to looking at the actual valuation calculation. We normally do two valuations. One's a free cash flow, a future cash flow valuation, and we're looking at obviously our base year being our most recent year. We then take some fairly conservative growth metrics. So you can see here we've got a fairly conservative growth rate based on history, etc. And we've just discounted that cash flow back to the current value, which in this particular slide is 5.245 million, less our debt figure, and we come up with a net value for the particular business. Next thing we will do is have a look at the future maintainable profits valuation. There we go. And this valuation, very, very similar methodology, and I'll talk in a moment about the difference between the two. But the key thing here is we've still got the very conservative growth rate in the middle. In fact, with a lot of clients, we use a net profit growth rate of probably 5% in the next year or two, and then we might even drop it down to 2 or even 3% because we're quite conservative around growth rate. It does have a big impact on the valuation. Now, obviously, what happens here is you come up with a fairly consistent valuation. Those two numbers are often different, but they should not be different by a ridiculous amount of money. You know, they should be fairly close to each other. If they're not, it's an indication to have a good look at why, and perhaps to have a good look at which methodology is the best methodology in terms of the valuation. We normally put both in. Now, the important thing that we do then is also talk to business owners about the current valuation and how do they improve it. One of our premises is that for most clients, we can actually improve the valuation of the business, not just determine what it is today. And the methodology that we use to do that is simply this particular slide here. So our current value is 5.25. That's equivalent to a multiple of 3.97, which is probably okay in terms of market averages. And I'll talk in a minute about a reasonableness test. What we're saying now is that based on benchmarking and improving our financial performance, the next two columns see an increase in valuation, but it's not an increase in the multiple. It's an increase in the financial performance of the business, so the EBIT. And that number then goes from 1.3 to 1.57 to 1.618, etc. And so our valuation increases accordingly, not substantially, but it does increase because we've improved our profitability based on those numbers. The last two columns then say that we leave the profitability as it is at $1.618 million, and we then improve the multiple. So how do we do that? Well, firstly, we go back to those non-financial and readiness attractiveness slides and work out how we can actually improve the attractiveness. If we can make the business more attractive, if we can add some strategic value, if we can reduce some risk, then we've got a good argument to increase the multiple. In this example, the multiple's gone from 3.97 to 5. And lastly, if we can really get to a strategic exit, if we can find a listed company or a strategic buyer, then we can get the multiple from 5 to 6. And you can see that has quite a substantial impact on the overall valuation of the business. So really important to get clear that that's an important strategy. And lots of business owners, you know, in some cases, very happy to sell it at 5.25. Let's get on with it. Let's do it. That's more than enough money for me. I've made plenty of money over the years. But in a lot of cases, we're looking to increase the value of the business before we exit. And so we work with business owners on that process using this particular methodology around profit and value potential to improve the outcome, etc. So just a couple of key things before we finish up. We have got about 4 or 5 minutes for questions at the end, which I'm happy to answer. But let's just a couple of key things before we finish up. First thing is we're still looking for accredited advisors in some areas. In some cases, we've got plenty of accredited advisors, and I noticed that slide's got nothing in WA on it. Yes, it has. It's just under Queensland. Bunbury and Bustleton would not be happy to know they're now part of Queensland. They're actually part of WA, but anyway. So you'll see on there areas around the country where we're still looking for accredited advisors to join our team. We do have client inquiry in some of those areas and are looking for people to help our clients. As I said, we've already got 24 on board, but we're looking to expand in certain areas. The Advisor Masterclass series. So just as a reminder before we finish up with questions, we've already had 2 sessions, the first one on succession and the psychology of succession. Today's session on business valuation. There's another 8 of these sessions to come over the next 8 months, 1 per month. And it's at the same date. It's normally the second Tuesday of every month, second Thursday, sorry, of every month, but they're all on our website if you want to have a look at those. And you'll see there's specific topics for each session. A bit like today, we're going to cover off on one main important area around business succession and exit planning to make sure that we're actually covering that off and everybody's clear on those particular areas from an advisor's point of view. So I encourage you to join in on those future dates if they are possible for you in your diary. There's also, the sessions are also recorded, so if you do register for them but you can't attend for some reason, you will be able to get a copy of the slides at some future date. So we do have 3 or 4 minutes before 11:15 when we finish up. If people do have questions, please type them into that chat box on your bottom right, and I will try and get through as many as I can. If there's any that I can't get to or that are just simply too detailed for today's session, I'm happy to answer them later on, and I'll contact you afterwards to do that if that's the case. I'm very happy to answer them, but sometimes it's not appropriate to answer them in this forum because they're just far too detailed or complicated. So please, if there are any questions, let me know. I've got a couple that have just popped up here. So the first one is, what does a typical valuation cost? And I guess that's a question I often get asked. It's also a question that is typically, how long's a piece of string? You can do a simple short form valuation for a small business without a lot of complication for probably $3,000 to $5,000. But we have done valuations for businesses for $30,000 and $40,000 because they've got multiple entities in different locations with different operating parameters, etc. And they're larger businesses. They might turn over $50 million. There's a lot of complication and risk around how that's managed. So unfortunately, I can't really answer that question. Typically for our clients that do a stage 1 report, which I've shown you the sort of the main contents of today, typically for those clients, then that is going to be somewhere between a sort of $8,000 to $12,000 or $15,000 process, depending on the size and complexity of their business. So there's another couple of questions here. $1 million of working capital is required to generate the revenue. How is that dealt with in the valuation? So you'll actually see, if I'm just going to flick back through the slides while I'm talking to you to find the right spot to show you exactly how that's treated in the valuation. So you'll see in this slide here in the section, I'm just going to highlight it for you without making a mess. This section here in blue, you'll actually see the balance sheet actually comes into that equation. So total net assets is equivalent to your working capital question. And you can see here the actual return in the middle of that screen there in the box in yellow or orange is actually a calculation of the net assets on the balance sheet divided by the profit. And that actually then gives you the economic return equation. So that's that question. We've got a couple more here. The product you're using, I'm assuming, is specific to Succession Plus. Yeah. So the stage 1 report we've designed over, what is basically 10 years of dealing with clients. It's 10 years next year. Anyway, we're only at 9 years today. 10 years of dealing with clients. We've designed this specific report called a stage 1 report, which we think covers all the key things that clients need to know in terms of a business valuation and also a plan going forward around their succession and exit planning. So yes, it is specific to Succession Plus. Having said that, if you wanted to go out and do a valuation, there are a number of different software products on the market that you can use to create similar sorts of valuation reports to what we use. We've just designed a specific report, mainly, David, because it's specifically targeted at the issue of succession. We also do, and it doesn't look like the format that I've shown you today, but we do valuations for things like, we're just doing one at the moment for a family law court proceedings. We do them for clients who are looking to restructure for things like capital gains tax or stamp duty calculations, where they're needed for the ATO or the Office of State Revenue, etc. We sometimes do them just as an inquiry. We might well be looking at merger of two businesses, so it's probably not a stage 1 report. It might be a more detailed technical style valuation. So we do them for different purposes, and obviously those reports look different to the reports that you've seen today. I think that's all the questions. I've certainly answered all the ones that are on my screen currently. So if you do have a question, I haven't got to it, I apologise. Feel free though to follow up with me either by phone or email. My contact details are on the screen. And I thank you for coming along today and joining in. I hope it's been helpful and useful, and I would encourage you to join us next month for the next part of our series. Thanks very much, everyone. Have a great day.